to this webinar on the September FOMC meeting review as well as our investment implications. My name is Tai Hui. I'm the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And in the next 30 minutes or so, I'm going to hopefully share with you three things. Number one, obviously some of the key messages, observations from the latest FOMC meeting, as well as the updated summary of economic projections. Number two, a really quick recap of the current situation of the US economy and what does that mean for Fed policy going forward. And finally, and perhaps the most importantly, what does that mean for investors around the world, especially given the context of the rate cut cycle has restarted? What does that mean for investors? What does that mean for equities, fixed income, some of the alternative assets that we have been looking at over time? So before we start, as always, if you do want to subscribe to our podcasts on the Investors' Minds, we have a QR code here. And of course, if you do want to get some of the charts that you see today, where most of them we update every day, there's the daily guide to the markets, Asia, where you can also, the bottom half of this page, the QR code. Look, 25 basis points, no surprise there, 4% to 4.25 in terms of policy rates. I think that's been largely expected. There were some whispers of maybe a 50, and frankly, that never looked likely to us because I think, despite the softness in the job market, the reality is, the economy is not in such a dire state. If you look back to the July meeting, Waller and Bowman, they both voted for 25. They also voted for 25 this time round. So overall, I think there is still consensus when it comes to voting on the policy rates. But as you see in just a moment, in terms of the forecast, I think there are some significant divergence within the FOMC. Now, before we get there, very quickly, in terms of the statements, I think there is a clear pivot towards a greater emphasis on the softness in the job market, no longer just focusing on inflation, even though I think the statements, as well as Jay Powell did mention in the press conference, that inflation remains elevated. And of course, we're still watchful over the potential impact from tariffs. Again, a point I'll come back to when we talk about the US economy. But I think the key change between the July meeting and the September meeting was those non-farm payroll numbers. Not only the July and August numbers were weaker than expected, but the May and June numbers were revised down. And frankly, as you saw with the 12-month revision that came through 2 weeks ago, those revisions were very significant on the downside. So I think the big difference, I have to confess, put my hand up in guilt, that this web conference, after the July FOMC, I was banging on the table talking about the Fed cannot cut in September because of the solid job market. But guess what? 24 hours later, the non-farm payroll data came and the revisions came, and that painted a much weaker job numbers on the job market in the US. And I think that gave the Fed FOMC the green light to cut in September. Now, again, just preempt in terms of what I expect to see over the next few meetings. As long as the job market remains on the softer side, I think October and December are still very much live with potential 25 basis point cuts. I think over the course of the remainder of Q3, Q4, first quarter, first half next year, I'm expecting to see 125 to 150 basis point cuts. That will bring us to around 3%, which is effectively the long-term neutral rates from a Fed's perspective. I think that's a sensible place to pause unless the US economy moves into a much weaker footing. So let's look at the latest forecast. So on the screen right now, what you see is the latest September forecast. I think the growth numbers, the inflation numbers, there's some mild revision upwards for 2026. Nothing too dramatic there. And the unemployment rates for 2026, 2027 has been revised down slightly. That perhaps reflects on the tightness in the labor supply, especially with anti-immigration policies coming out from the White House. Where I think the most important updates here is really the Fed funds rates at the end of each of these forecasting years. And what you see here is for 2025, 3.6% versus the June forecast of 3.9%, and then 2026, 3.4, 2027, 3.1. Now, what this means, what this implies, the median number is that we are, well, at least from a FOMC perspective, the median forecast is for another 2 cuts before the end of the year, and then 1 more cut in 2026, another cut in 2027. But I think at this point, frankly, because the economy is throwing out such volatile set of numbers on the job market, the inflation numbers, as well as broad economic growth, I think the FOMC members are really focusing on more the short-term aspects of rate cuts rather than thinking too far along the timeline. But I think the interesting point is on the next page here, what I've done is I've compared the June and September dot plots. The left-hand side is the June data, the June forecast. The right-hand side is the September numbers. Look, I want to start with the September numbers first. If you look at September number 2025, which is the right-hand chart, but the left-hand column, first of all, there are 2 very weird dots, right? There's one at the top, which one FOMC members are effectively forecasting no change in last night's meeting, and a no change for the rest of this year. I think that you can always dismiss that as someone who has a very firm view of no change. Another very interesting dot is obviously right at the bottom, where you have effectively over the 3 meetings in September, October, December, this particular FOMC member is gunning for 50 in every single one of them. No price is guessing who. But again, I think we can just dismiss that as someone who has a rather extreme view. But I think the important point here is if you look at the distribution of the dots for 2025, there are a number of members who are forecasting 2 cuts, in about one cut each in October and in December. And then there's another group, about 6 of them are predicting, well, rates are going to be staying roughly where it is for the rest of this year. So I think there is still sufficient division within the Federal Reserve, within the FOMC, in terms of the outlook of policy rates. If you look at 2026, the distribution is even broader, and then for each particular policy rates level, with the exception of 3.5 to 3.75, or between that level, frankly, there's a wide division within the Fed. So I think what this tells us is the macroeconomic data coming out from the US, it's volatile, and frankly, these FOMC members, they do need to observe these numbers before making a decision. This reflects the uncertainty both in the economic data, the economy, and what's the appropriate policy response. So in that sense, we often get asked the question, do I think October is going to be a rate cut or no cuts? Frankly, to me, the most important point is think about the next 12 to 18 months, or between now and the end of next year, what will be the appropriate level of overall rate cuts, and then devise our investment strategy accordingly. It's very attractive, especially with the media, to trying to predict and forecast very precisely how each meeting will go. But the truth is, this is still very data dependent, as Jay Powell mentioned in his press conference. But again, at the same time, even FOMC members themselves do not have a firm consensus of where things should go. But the reality is, I think that a couple of things that are clear, and I'll come back to this now, and that's looking at the US economy. If you look at the labor market, the chart on the screen right now, or page 29 of the Guide to the Markets, you see that on the left-hand chart, job numbers have been decelerating quite significantly. And the June number was actually revised to a negative job growth for the first time since the pandemic. So it is pretty clear right now that the corporate sector are pausing, or at least slowing down, on hiring. Now, Unemployment rate is gradually creeping up now at 4.3%. It's not super high, but the direction of travel continues to be, on the rise. And that to us implies that the US economy is likely to move to a slower gear, for the rest of this year and then into 2026. So in that context, I think it does make sense for the Federal Reserve to take some of that interest rates off the table, because right now we're still above neutral, hence we're still in a relatively tight monetary condition or monetary environment for the US. So it does make sense for the Fed to take some of that interest rates off, but not to the point of relaxed monetary policy, because ultimately, if you look at the next page on the inflation front, inflation, whichever indicator you use, whether it's the PC deflator or the headline inflation or core inflation, is still above the 2% target by the Federal Reserve. If you look at the last few months, which is on the next page, what you find here is there were some seasonal factors helping to push services, to push energy prices down. But at the same time, some of these seasonal factors are starting to fade away. And energy costs, as we saw in the August numbers, as well as rent and services, the decline or the slowdown in inflation in these categories are slowing down or pausing. The good news is we've yet to observe a meaningful increase in core good prices because of tariffs. This may be because companies are absorbing some of that extra cost themselves because they don't know whether some of these tariffs could be rolled back for a number of reasons, whether it's the Trump administration striking trade deals with trade partners, for example, with India, where current level of tariff 50%, could that be brought down to a lower, more reasonable level? I think perhaps yes. So companies may look at that and say, well, if these tariff rates are coming down, I may not want to pass all that cost onto my customers right away. I want to wait. That's one possibility. The second possibility is obviously some of the legal cases against tariffs. Courts have already ruled that these tariffs are, or President Trump imposing these tariffs on emergency grounds are not lawful. And this will continue to escalate maybe towards Supreme Court later in the year. And again, some of these companies, importers, retailers may be thinking, well, let me just wait and see the final ruling before I pass it on to customers. So I think there has been some delayed effect on tariffs, from tariffs on imported goods or towards consumer goods. But nonetheless, I think the Fed is still dealing with some residual effect of inflationary pressure from the past few years. So I think overall, a gradual reduction in interest rates makes a lot of sense. Aggressive cut in interest rates, to me, does not make sense because the economy is not in such a bad situation. And meanwhile, there is still some inflationary pressure in the economy. And the other thing that we want to discuss is the corporate investment, because some of you may remember I mentioned a number of times over the past few years that if you look at the US economy, recessions are typically triggered not by consumer spending cutbacks, but by either corporate investment cutback or housing investment cutback, because housing investment and corporate investment typically are the more volatile components of the economy. Consumers, of course, they may spend less on discretionary items. However, a lot of their spending are, compulsory. They have to spend on food. They have to spend on traveling to work. They have to spend on basic necessities, and that's why consumer spending typically is the stable part of the U.S. economy, despite it being the largest component of the GDP calculation. But when you look at corporate spending, if corporate earnings are slowing down or contracting, you will not be surprised to see companies pulling back on investment, pausing on hiring. I think we're starting to see some of that right now. And especially, there is a divergence in corporate investment in the US where you've got your tech companies continue to invest aggressively into artificial intelligence. I think that helps to support a significant share of that capex, whereas the non-tech part of the economy, because of tariffs, because of a lot of policy uncertainties from the Trump administration, they may want to just hold back for the time being. So not only in the stock market, we see this divergence of tech versus non-tech in terms of earnings and performance, but even in the real economy, you see something similar in terms of corporate investment, especially relating to AI. So overall, I think the macro policy backdrop I foresee going into Q4, maybe into 2026, is that the Fed is restarting its rate cut cycle, and we are in still a soft landing economic environment. Growth will decelerate, something that we've been highlighting for much of this year, but we still think the U.S. economy can avoid a sharp recession for a couple of reasons. First of all, corporate leverage and household leverage, from our perspective, is manageable. We're not in those pre-2008 time where corporates and households are over leveraged. So even if the growth momentum slows down, companies don't have to aggressively cut back. Households don't have to aggressively cut back on their spending in order to sort of survive the recession, which obviously helps to reduce the severity of recession. And of course, the other thing to bear in mind is that the big beautiful bill, while some people may be very critical of it on adding to deficits and government debt, some of these measures will help to provide a bit of a lift to consumption in the early part of 2026. You may remember things like tips, overtime, some of these payments or some of these income, they will get significant tax deductions or tax exemptions. And when these employees report their taxes in next year, I think some of these rebates will actually be supporting their income in the early part of 2026. So in that sense, I think it does provide a bit of a cushion to the US economy, despite its more conservative view from corporate CEOs and corporate investment. So bottom line is a restart of the rate cut cycle in an environment of an economic soft landing. And that is extremely important when we come to talking about what does that mean for investors. And this page, we've whipped this out a couple of times in the last 12 months. And I want to reintroduce this once again. And what this chart tells us is a couple of things. One, what this maps out is looking back to the number of rate cut cycles, what's been the performance of equities, fixed income, other assets, 12 months after the first rate cut. In fact, we do have an update of this chart to include the 2024 September rate cuts. And the conclusion remains largely the same. What you see here is that some of the green dots indicating the 2001 recession and 2007 recession, these are obviously the dot-com bust and the GFC. No surprise that the equity market had a really difficult time. Right? If you look at, for example, AC World, minus 20%, minus 25% in terms of 12-month performance after the first cut by the Fed. But if you look at some of the soft landing scenarios, for example, 1995, 1998, 2019, this is before the pandemic hit, equity performance actually was quite respectable. So if you look at, again, using AC World as an example, what you find is, after the first rate cuts, in a soft landing environment, equity return can still be double digit. Now, if I add 2024, so 12 months ago, I don't think I have to remind you that equities have also done very well over time. So I think the key thesis that we have going into 2026 is that relaxation of monetary policy alongside with a moderate slowdown in growth that helps to protect earnings performance, that should be a constructive combination for risk assets. For fixed income, no surprise, rate cuts, yields comes down, bond price goes up. So, no surprise that if you look at treasuries, in most cases, you can generate a positive return. We can argue and debate whether we want to go long duration or neutral or short. I'm happy to take questions, after my presentation as well. But overall, we are again in a similar environment where yields are likely to come down, but because of the economic soft landing, we're not expecting a significant widening of corporate credit spreads for investment grade corporate debt or high yields. So that to me, it does provide quite a positive environment for investors over the course of next 12 to 18 months going into 2026. Now, despite everything I've said so far, one word of caution is that if you look at the market returns year to date in equities, which is on the screen right now, or page 34 of the Guide to the Markets, we've had a great year, right? We've had a great year for equities. If you look at Asian markets, APAC ex-Japan, 25% year-to-date return. Some markets like Korea, China, Taiwan, year-to-date, excellent performance. If you scan across the page, my question now is, between now and the end of the year, look, this is a very rough, very simplistic way of thinking what could happen over the course of this year. If you look across the page, let's take Korea as an example. Again, this is a benchmark, obviously. 2025 year to date is already better than any of the last 10 years when Korea had a really good performance. The best I can see on the screen is 2017, 47%, 2020, 45%. My question is there any chance for the MSCI Korea to do another 10% up from where we are now? Look, of course, there's always the possibility, but statistically speaking, that is a bit of a stretch. And I would argue the same for a lot of these equity markets, which implies that there could well be some short-term factors prompting investors to take some profit for the market to pull back. But if that happens, I've got no way to tell you exactly when or how that would happen. But if that happens, combining my previous chart, that tells you in the longer run or over the next 12 months, rate cuts plus soft landing is constructive for risk assets. Any pullback to me could well be a good opportunity to reload on global equities, on Asian equities, if you do not have that position already, or if you do not have a sufficient position already. So that's one thing to bear in mind. I don't want to advocate timing the market, but I also want to put it out there that we've had a very strong 2025. We have to be aware of the risk of a pullback and how should investors consider this type of market volatilities. Another way to prepare for potential market volatilities or pullbacks is deploy option strategy. Because ultimately, if you do have some volatilities, your options premium is likely to rise alongside with market volatilities. And B, despite the pullback in the markets, you are getting that options premium, which potentially offsets some of that pullback. So I think there are many ways that we can continue to engage in global equities, in US equities, in Asian equities, but at the same time being savvy on how to manage short-term volatilities that we could see between now and the end of the year. And again, just thinking back some of these equity questions, if you look at the earnings outlook, I would say for US, for Europe, things are looking, frankly, better than I thought. Again, at the start of this year, I was being cautious on how quickly US corporate earnings can grow. You may remember I mentioned in the past that over the cycle, S&P 500 EPS growth averages around 7%. So, if you tell me in 2025, where growth is decelerating, yet earnings growth can still accelerate, I would have said, but I did say that doesn't look likely to me. But if you look at where we are now, the market is still, or consensus forecast is still for 2025 earnings to be at around 10%. Of course, AI, technology, that is a big part. They do a lot of the heavy lifting in supporting earnings growth. but into 2026, still double digit. Again, I will be a little bit more cautious on that, but I think the outlook continues to be supportive of equities around the world. Valuation is one thing I think a lot of investors who are cautious are pushing back on. If you look at S&P 500, the price to earnings ratio, even some of the APAC markets. If you look at APAC ex-Japan, 16.7 times, that towards the more expensive end of the range, partly because of, you can see Taiwan, again, being a bit more expensive. Some of the larger markets like China, like Korea, they're no longer below average because of the strong performance. They've gradually crept up in their valuations. So I think the warning or the caution I mentioned earlier about market corrections really built on, we've seen a lot of valuation re-rating. We think some of these markets, for example, Taiwan, for some parts of Korea, for example, the AI demand will continue to support their earnings outlook. For China, especially the offshore market, again, AI, new consumerism, the anti-involution or anti-excessive competition drive, all of these should support earnings in the medium and longer term. But there are other aspects or there are other areas where we do see more liquidity-driven liquidity-driven valuation re-rating rather than fundamentals, earnings driving valuation re-rating. And I think that's where investors have to be a little bit more cautious. So again, combining everything together, if I'm taking a 12, 18 months, 2-year view, I would still be constructive on equities or risk assets. Taking a slightly shorter term view, 3 months between now and the end of the year, I think option strategy, a more diversified portfolio can certainly help investors to navigate the potential volatilities that we could see in the short term. Fixed income plays a key role, right? If you look at, again, last 6 months return from some of these fixed income assets, most of them, the price return component have made a positive contribution, which is great, right? But at the same time, the dark blue components, for example, in US high yields, in developed market high yields, in Asian high yields, they also make a significant contribution to total return. So I think in this environment, and sort of going into Q4 into 2026, I would expect the gray component, the contribution to be a bit smaller, but at the same time, the blue component, the income, the yield component will still generate return to investors. And because of that, again, I'm just going to repeat my recommendation on fixed income for the past 6 months, a barbell approach where you have government bonds and you have, for example, high yield developed markets or high yield US corporate debt. I think that the high yield side allows for a better yield pickup from the high yield corporate debt. But in case growth slows down or the Fed adopt a more dovish position, then your government bonds, your treasuries can provide more of the offset or the income generation as well as the capital gain from lower bond yields. Now, the questions on duration, for much of this year, we've been focused more on the short to neutral duration. I think we will still keep to that because the long end, let's say 10 to 30 years, the challenge is questions over US fiscal sustainability that will always be around. I don't think it's going to create a stress situation like we saw in the UK or we saw that in France to some extent. But investors will still demand a higher term premium to compensate for the rising level of fiscal debt in the US. And of course, the question over the Fed's independence. So, one of the Fed governors, Lisa Cook, the court has allowed her to remain as a Fed governor, and she clearly voted in last night's meeting. But as we roll into 2026, with Jay Powell, chairmanship ending in May, what does that mean for the composition of the Fed? Could we see more dovish members being brought into the committee? I think that to me is going to be another key question, especially that could impact the longer end of the yield curve. So, I think that's one reason why, we're a bit more cautious on the longer end of the yield curve, unless we see much weaker economic data coming out from the US. But our investment strategy clearly is not limited to equities and fixed income or public markets. There are private markets, there are alternatives that we think can also help investors. Two examples here. One is global infrastructure. Ultimately, we are in a world of not deglobalization, but the globalization being reshuffled, being reorganized, supply chains being more complicated, which means that infrastructure in many emerging markets will require significant investment. That creates opportunities, but what you see here on the screen right now is global core infrastructure return. Not only the income component is very consistent, but also the capital appreciation over time, with the exception of sharp recessions or pandemic, also generate returns for investors. If you look at the box, the top right-hand side, power, that's not only to do with the growth of emerging markets, with emerging market consumers, maybe hotter weather requiring more air conditioning. More importantly, artificial intelligence, data center will be a huge demand creator for power. So I think whether it's in Asia, we have seen China, in Southeast Asian markets like Malaysia, like in Japan, like in the US, in Europe, as companies invest more in data centers, the power generation capacity will rise in line. Other areas like transportation, as I mentioned earlier, infrastructure being more spread out because supply chain is more complex. All of these will require more ports, more roads and railways to move the goods around the world. So I think that's one area we find a lot of interesting investment opportunities for investors. The other one is hedge funds. Hedge fund performance, I mentioned earlier, we may see a pickup in market volatilities. If you use the VIX index as a proxy, what you find here is when the VIX index picks up, on the bottom chart, for example, towards a range of 25 to 30, your global equity index typically had a tougher time, but you find that in high volatility environment, 25 to 30 or 35 to 30, 30, 35, hedge fund performance clearly can provide some offset to investors. If it's a low volatility environment, maybe not. Maybe it's just sticking back to public markets, but in a high volatility environment, hedge funds do play an important role to investors. And another important point to recognize is that the performance of hedge funds, the managed selection is absolutely crucial. The variations, the deviations of performance can be very significant. So if you're interested in this area, I'll recommend you to take a look at our guide to alternatives, where we dive into in a lot of details on private markets, alternatives, including infrastructure I mentioned earlier, hedge funds, private credits, private equities. I think that is a very rich source of information if you want to understand more about private markets, about alternatives. So to summarize, I think a few key takeaways. Number one, the Fed has restarted its rate cut cycle. The good news is we think the US economy is still in reasonably good shape. And therefore, the rate cut cycle combined with a soft landing in the US economy, that provides a very favorable environment for risk assets. We're not too concerned about risk assets over the next 12 to 18 months. I think we need to be mindful the risk of a correction because markets come a long way. If you look at the year-to-date performance, if you look at valuations, I think there could well be reasons for investors to rebalance, to take some profits. But from our perspective, this is not something we should be worried about because we have ways to manage that volatility. I mentioned option strategies to generate options premium to offset that downside. But at the same time, alternative strategies like hedge funds, again, can provide that level of protection to investors. But also at the same time, in the longer run, rate cuts and soft landing, good for equities. And I understand many investors in APAC, they still have a fairly high cash level. So from that perspective, a correction in the market could potentially attract investors to deploy that cash using that as an entry point back into the markets. And then in terms of fixed income, the barbell approach continues. Government bonds, high yield corporate debt. If the economy remains in a soft landing mode, defaults do not rise materially. Obviously, the high yield corporate debt bond price is likely to remain largely stable, and then you can really just capture that income component. If I'm wrong, the US economy decelerates much more than expected, then your government bonds components can provide some offset. So again, I think a lot of investors are concerned about the potential economic volatilities in the next 3 to 6 months or next 1 year. But from our perspective, we think there are plenty of ways we can help investors to navigate through those volatilities, both in the economy as well as in the markets. So any questions on strategies, feel free to reach out to your JP Morgan Asset Management client advisors, and of course, to any of our market strategists, my team. They're always around to help if you have any questions. Our next web conference is going to be in early October for our fourth quarter guide to the markets launch. I'm sure we'll touch on a lot of these questions once again, but I hope you can join us in that particular event. Have a great week ahead, and I'll see you next time.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.